All right, I'm going to go ahead and get started. I have just a few announcements, and hopefully by then Jared will have popped into the room. So you're hearing it here first. Link and Learn will be up tomorrow. I just got an email about 15 minutes ago, and so if you haven't checked your email since then, um, you know that Link and Learn is available. Now, I did put in my email, everybody and their brother all across the US is also going to be trying to get into Link and Learn tomorrow. So just be prepared for it to be maybe a little bit busy. But they told me it will be up tomorrow. I didn't get a time, like by 6 a.m. or noon or whatever, just said tomorrow. So for those of you that, I apologize if I keep looking away. I just want to make sure I'm getting everybody as they're letting them into the room as they pop in. For those of you that are in Lancaster County, I am looking for a few individuals who might be willing to do a shift as a site coordinator. I know there are some of you out there that have been site coordinators before, so it's not for a whole site, it's just for a shift. And I'm looking at our downtown office on King Street and possibly a pop-up or two. Ah, there's Jared. So if you would be interested in doing that for me, please let me know, touch base outside of here, and we will get you connected. I only have a couple shifts I have to cover, so anyone who might be interested. I think I had mentioned last week too that we're looking for individuals who might be willing to take some phone calls for us. So we're trying, I know I mentioned in our morning session that we use AnswerNet, which is our software company for scheduling. And then we also, I'm sorry, AnswerNet is the company that answers the phones. Census9 is the vendor for the scheduling app. For each site that we have and that uses Census9 to schedule, it's $1,250 per site. So we're looking at about $16,000-$17,000 there. For AnswerNet, last year they told us that they answered phones for us in the total of 63,000 minutes. Each minute is $1.12. So that was close to probably about $75,000. Our total bill was about $92,000. So in an effort to decrease our costs, we're looking to see if we get some volunteers who would be willing to answer the phones to schedule appointments. There will be training, there'll be some software, software training. We'll also have some laptops for folks to use and hopefully some headsets that folks can use so that it'll sound very professional and you can do it from home. You do not need to come into any of our offices. This is something that you can do from home. So I'll be sending out another email. And if you are interested, you can get in touch with me. But Jerissa Johns is our volunteer coordinator, and she is spearheading this for us. So you can also get in touch with her. I also mentioned that this year, and some of you that were with us last season knew that we were doing a project with the Central Pennsylvania Food Bank. And we were doing pop-ups at some of their food pantries. We will be doing that again this year. I am trying to schedule those the last week of January and the first week of February to get those completed for the food pantries. We will be starting our King Street office. We'll open that on February 10th. So I'm hoping that if there's some folks at King that usually work King Street during the day, if they might be willing to help with those food pantries. There's going to be one down near Paradise, one in Quarryville again. There'll be two in New Holland. And then there's a couple other ones. One will be at Temple Clubhouse. We did those last year. So there's some opportunities for folks to help out with our pop-ups, and I would greatly appreciate that. Also, right now, the only site in Lancaster County that is open on Fridays is our Hempfield office. We're looking at extending some hours at the Harrington office, which is on Harrington out by the old Kmart off of Fruitville Pike. And if you could put, and this is not set in stone, but if you would be interested and available to help to work on a Friday, could you just put a yes in the chat so I can look at that and know um, how many people might be interested in working on Fridays? I'm not sure why or how the schedule came about. When I took over a couple years ago, I just kept things as they were. And at that time the only site that was open was Hempfield. But if you would be interested, willing, think about it, maybe helping out on a Friday, just put a yes in the chat so I know how many folks. All right, so that's all the announcements that I have. So Jared, take it away.
Thank you very much, Kim. Hopefully everyone's doing all right this evening. Hopefully everyone can hear me okay. All
There he
right.
is.
Good. All right.
I
Yeah,
think
having
you're
a
muted. I can't
Oh, can you not hear me? All right. Let me try
tell
one of
nothing. I
Okay.
see your mouth moving, but I can't hear anything.
We can hear you,
Oh, you
Jared.
can? I just
Yeah.
can't hear. Okay.
Okay, great. Glad thank you very much that you can at least hear me. We'll see how we can do on the video presentation here. I'm going to go ahead and share our screen here. Um, So we will go ahead and take a look at tonight's session. Fortunately, this one is going to be a little bit more exciting than others we've had in the past here, because what we're going to be talking about this evening is really how do we take a look at items of deductions and credits. So some things that we can take a look at. How do we help reduce taxable income, or more importantly, tax liability for our for the VITA clients. So hopefully, are we able to see the slide set all right? Okay. And are we okay on the
Yes.
video still? Perfect. All right. Appreciate it. Thank you very much. So the first thing we're going to kick off today is talking a little bit about the concept of our well, let me see. There we go. Okay. Adjustments to income. I apologize. For some reason, I have a bit of a lag here this evening. We'll try and work through it. In fact, now we're going multiple scrolling. We'll try and go one at a time here, make it a little bit easier for everyone. So the first thing we want to talk about are a couple adjustments to income. So you'll find these in E3 of your 4012. What these are actually kind of are deductions that are still available for individuals who are filing returns. So you can actually take these, even if you're going to take a standard deduction, but these are adjustments to income. So these are going to be reported on Form 1040. There's a Schedule 1, Part 2. The only reason I mention this is because where it's going to be filing or showing up on the return as we get ready to file. The input's still going to be within Tax Slayer. These are all going to be common adjustments that we'll have that are within scope. So I'll talk a little bit more about educator expenses. So I have a couple pieces of information we want to talk about that. A lot more information on health savings accounts, and there's some really good opportunity we have on the HSAs. Fortunately, that is now back within a traditional scope. We usually had a HSA exam before. That's now encapsulated within the advanced certification, so you should be good to go. Also, we mentioned a little bit last time when we talked about INTs, Form 1099 INT, that if you had a penalty on an early withdrawal of a savings or a certificate of deposit account, that is going to be a deduction that's automatically going to populate whenever you enter that information off the 1099-T. Also give you a little bit more information about a couple other areas, such as our alimony, and then also IRA deduction, and then lastly, talking about student loan interest deduction. So I want to go ahead and take a look here at our next slide, which is going to talk a little bit more about educator expenses in more detail. So educator expenses, again, E8, if you're looking for a little bit more information. This is the same rate we've had in prior years. So you may have clients coming back again and wondering about the educator expenses. Qualified educators or eligible educators can take up to $300 of qualified expenses during the year. Now, what we're talking about here is that they can take up to 300. If they have less than 300, obviously it's going to be the lower of the two amounts. And while sometimes we may have people come in and say, I just put me down for the maximum each year, I do want to mention not only do we have a federal deduction here, but for those of you who are preparing returns in PA, Pennsylvania also allows an educator deduction. We're going to talk about that in our next session, which is going to be focusing mainly on state, local, and a couple other items. So it's important that we actually try and identify how much we have in expenditures. So while federal may be capped at $300, PA will allow whatever the actual amount of qualified expenses could be. Now, when we take a look at eligible educator, there's a couple things we want to keep in mind. It would include the definition, including a teacher, an instructor, a counselor, a principal, or an aide in a school. Now, unfortunately, homeschool does not count, so it has to be in a private or public school setting, teaching grades from kindergarten all the way through grade 12. And as long as you're employed for at least 900 hours during the school year, then you're eligible to take up to that $300 of deduction per year. If you have two taxpayers, if both happen to meet the definition of an eligible educator, then we could take $300 up to $300 for each. The qualifying expenses which would qualify here are going to be things like books, supplies, any type of equipment. So that could be computer equipment, it could be software, it could be services, could be lab materials, kind of bulletin board materials, that type of thing. Anything you're using in the classroom, basically for education and academic purposes. Also includes any protective equipment and disinfectant. So that's still a holdover from the COVID years, but that's still also included. Also would be professional development activities. So if people are going off for training or a conference, that can be included as well. Now, just as a point here, we are not allowed to take any deduction that might be reduced by any school reimbursement. So if a instructor is getting a reimbursement from the school, whether it's through payroll or maybe they've received a tax-free grant, we're going to have to reduce the cost of before we can deduct it on the return. So just want to point out we have a little bit of a opportunity there to see, do we have any reimbursement? Do we have any grant related expenditures that would reduce the total amount? Now, one of the things we're going to be talking about mainly in this session is how many of these deductions and credits come into play and where they come from. So everything that we see as a deduction is all going to be part of the legislative process. There's actually a reason why these are all in here. And we try and identify exactly what's causing these. What is the benefit behind a tax deduction or a tax credit? So in this case, we have educator expenses. So it's helping out people who are in an environment where they're teaching impressionable children. We want to give them the tools and resources available in case their school cannot or will not pay for it to give them the opportunity for a deduction. Now, somewhere in the discussion of where the educator expenses should come from, there's a slight carve out. So generally, any teacher, any instructor, any counselor, principal, or aide in a school can go ahead and take the deduction. However, a major asterisk for someone who is a health or physical education instructor. So you cannot take any expenses for any non-athletic supplies. So if you have athletic supplies, that's fine. You can buy a bag of kickballs. That's okay. You can take a deduction, but any non-athletic supplies are not deductible for educator expenses. So a little carve out they have. I'm not quite sure where in the history of Congress, one of the Congress individuals did not like their health and PE classes. So those are not allowable as an expense for the educator deduction. So anyone who comes in who's a health or physical education teacher, unfortunately, any non-athletic supplies are going to be disallowed. So just one of those little wrinkles we have. We'll see a couple more of those as we go through this evening and talk a little bit more about a couple of these other expenses. So another one I want to mention here is going to be our health savings account. This is actually a fairly popular type plan and one that actually works out pretty nicely for some tax planning. So HSAs or health savings accounts, you'll find more information on E10 of your 4012. And basically, if we have an individual as a high deductible health insurance plan, and that can either be for themselves or for their family, they can establish what's called a health savings account. And how we get to a high deductible plan is it's really a health plan designed for lower monthly premiums. But the offset is that it takes a while before your insurance is going to kick in. You actually have a lot of out-of-pocket costs before you reach your deductible. So that's the entire basis behind a high deductible health insurance plan, effectively established to help individuals reduce the cost of health insurance particularly if they don't really have significant medical needs or have ongoing medical conditions. Now, the government has gone ahead and provided a health savings account to basically save up for these out of pocket medical expenses. So let's just assume that we have a traditional health insurance, which would cost $200 per month for employee coverage, but the employer offers a high deductible plan, and that's only $80 per month. Well, now what's happening is that employee is saving $80. I'm sorry, they're going to pay $80 per month for insurance rather than 200. So they're going to save $120 per month. Now, if the employee decided I'm going to take that savings and put it into a health savings account, that money's going to grow tax free as long as we use it for qualified medical expenses, which we'll talk about in just a minute here. So we're really encouraging employees to save money for medical costs. So as long as we're going through the HSA, traditionally those contributions can be made pre-tax. So whether the employee makes a pre-tax contribution or the employer makes a contribution on behalf of the employee, we'll generally see that in box 12 of the W-2 with the code W. We also may be getting a Form 5498 SA, which is going to show the individual's contributions to an HSA. I always recommend comparing the 5498 SA, if you get it, to the W-2 Box 12 Code W and see if those amounts match. If that's the case, then all of those deductions were made pre-tax. However, the employee could actually be given a tax deduction if they made contributions after tax. Generally, the way this may work is if they take a look at their HSA and they realize that the HSA has indicated they can actually contribute a little bit more. If they do that on an after tax basis, meaning not through a payroll deduction, the employer's not making the contribution, they can receive actually a deduction for that after tax contribution. So not only do we get that deduction for federal purposes, but also Pennsylvania allows for an after tax contribution deduction as well. So we actually have both a federal and state deduction. All the contributions, all the distributions are going to be shown on Form 8889. And just want to mention that we have had some changes in the contribution limits here for 2024. The amount is now up to $8,300 for a family plan. For a single only plan or self only plan, it's $4,150. And if you're age 55 or older, you can actually put an additional $1,000. So the benefit of the HSA is you can put money in tax free. The money's going to grow in that account. And as long as the distribution's for a qualified medical purpose, that distribution is going to be tax free as well. It's a great benefit overall. So I do want to talk a little bit more about the distributions from an HSA. So as long as the distribution is going to be used for the taxpayer, the spouse, or a qualified dependent, and it's used for qualified medical expenses, that distribution is going to be tax-free and no penalties at all. Likewise, if we have a distribution that was rolled over to another qualified HSA, that will also be a non-taxable event. So generally, what we're going to take a look at here is taking a look. We're going to get a 1099 SA showing any distributions from the account. And just got a question in on the chat here. Is the HSA deduction happen automatically in TaxSlayer from the W-2 input? So the W-2 input for the code W is going to show whatever that amount is will not be an actual deduction on the return. That actually is showing a pre-tax amount. So if you enter a code W in the W-2 box 12, that should generate the form 8889. But we have to ask the taxpayer if they made any non employer related contribution. So it has to be an after tax contribution. So we have to go ahead and double check and see if they made any contributions outside of the employment context. All right. But getting back to the distributions here. So technically a distribution, again, if as long as it's used for qualified medical costs for the qualified individual, taxpayer, spouse, or dependents, or rolled over to another qualified HSA, we're in great shape. So those are going to be similar medical costs that we're going to talk about for itemized deductions. So I'll reference that area in just a little bit here in the 4012. So that's going to be an opportunity here to use that for things like doctor's visits, your co-pays, any of your deductible costs, medication, eye care, dental work, a whole host of other things that can qualify. Generally, the HSAs are pretty much restricted in how you can use those. Typically, a HSA account holder will be given a debit card, And that debit card can usually be used for medical payments. So you can take that to the doctor's office. You can pay that if you have to do an online payment. You can use the HSA debit card. Generally, there's a restriction on who can accept an HSA debit card. So a doctor's office, a pharmacy can certainly take that. But I have yet to try and fill my tank with gas with an HSA card. Generally, the gas tank will not allow you to do that for a very specific reason. If a distribution is coming out from an HSA not used for medical expenses, not only are we now looking at a taxable income situation, much like we talked about last time with the 1099-R, it's going to be treated as a completely taxable transaction because, again, there was either a pre-tax or deductible component there. But now we have a penalty. So the penalty we had before with the 1099-R for retirement plan early was 10%. That was pretty bad. Not nearly as bad. This one is a 20% penalty. So this one's a much harsher penalty. Now, again, the penalty would be waived if the taxpayer is deceased, if they're disabled, or they reach age 65. So the good news is most people have a hard time taking money out of their HSA without being used for medical expenses. But again, we'll probably want to double check. They get a Form 1099 SA, generally show how much distributions they have. Again, it's a 1099 form. The government will get copies of it. So we should go ahead and record that as a distribution from an HSA and just double check with the client that they use that all for qualified medical costs during the year for either themselves or spouse or their dependents. Okay, any other questions on HSAs before we move on to alimony? There are some additional areas of detail on your 4012. So E14, actually, while we talk about alimony, there's actually some additional description of how HSAs work, what's included on E14 of your 4012. I did want to mention that. We also want to talk a little quickly here about alimony. So last time during the income session, we talked about alimony income as potentially taxable income. Now, again, I want to just go over the rules for alimony. So, if you have a divorce executed after 1984 and before 2019, so we're basically looking at 1985 to 2018, I'm anticipating that most of the divorces in the early 80s are probably finished up now in terms of alimony. If they're still paying alimony after 40 years, you have one of the best divorce attorneys ever. But generally, we're going to have those kind of wane down a bit here as those divorces continue. Any new divorces, anything happening after December 31st, 2018, there is no alimony deduction for the payor, and there's no alimony income for the recipient. The only time that we're going to see an alimony deduction is if the divorce was finalized before 2019, and that means that the payor gets to take a deduction potentially, and the recipient would have to pick that amount up as income. So we're going to see a tax matching provision there. So here's what's going to happen to treat pieces as alimony. Now, again, the good news is this is only for alimony that's been paid over time. Generally, most clients, if they've been divorced since 2018, have already been treating this as alimony paid. We just want to verify a couple of these pieces. Again, there's no form that's going to indicate how much was actually paid. So we're going to have to get that information from the client. So here are the definitions, and all of the following have to be true. We'll talk a little bit about some definitional concepts within the Internal Revenue section here. Not all of them are easy, plain, clear English, and I'm going to have you suspend a little bit of your English knowledge for a little bit here. So here are the things that have to happen for alimony to be considered alimony for tax purposes. The payments have to be required by a divorce or separation agreement. The payer spouse and the recipient spouse do not file a married filing joint return. Not quite sure why we have to go ahead and spell that out specifically here, because if you're still filing a joint return as a married couple, I'm not sure where the alimony is coming from. The payments have to be made in cash or cash equivalents. I am going to go ahead and for those of you who are big fans of the English language, I do apologize. We literally have a double negative in a definition. The payment isn't designated as not alimony. So we're not basically saying it has to be designated as alimony. We're just saying that the payment cannot be stated as something other than alimony, not alimony. So it's a bit of a word salad there. We're just trying to determine Does the decree say it is alimony? If it is, it's fine. As long as it doesn't specifically say this will not be treated as alimony, we still have the potential to treat that as alimony. Kind of going back to that whole payer and spouse still together, if they're legally separated, they cannot be in the same household. So alimony won't count if the spouses are legally separated under a divorce decree or separate maintenance and are still living together. They can't be in the same household. Payments also have to stop upon the death of the recipient. And we also have to make sure the payments are not treated as child support. Child support, as we mentioned last time, was not going to be included as income and not deductible by the payer. So for alimony, again, if we're in that situation between 85 and 2018, the individual paying the alimony can take a deduction. They do need to go ahead and record their spouse's social security number. And then the recipient would have to pick that up as taxable income. So again, good news is generally if people have been in this situation, they probably have already known that. So we'll probably take a look at the prior year return, see if alimony was paid, and maybe just make a quick inquiry. Did you have any alimony payments for 2024? Now, the IRA deduction. There's a couple things that we want to take a look at here for the IRA or individual retirement account or individual retirement arrangement. All kind of mean the same thing, what we talk about in IRA. This is on E15 of your 4012. Fortunately, that we can oftentimes make a deduction to a traditional IRA and receive a tax deduction. Now, I do want to make a mention here. In addition to the IRA, that you can make up till April 15th of the tax year. So what that means, we can still make a deduction up to April 15th, 2025 to have that count for the 2024 tax year. We can also do the same thing with HSA contributions as well. We have up until April 15th of 2025 to make a contribution that counts for the 2024 year. So some great items that we call basically post-tax planning opportunities, meaning we can still take deduction even though we've already hit December 31st. We can still go ahead and adjust our income by making contributions either to an HSA or an IRA or both. So give you a little bit of hint of what we need to take a look at here. While there are some AGI limitations for IRA deductibility that will not apply for our VITA clients, they're well beneath the AGI phase outs or adjusted gross income phase outs for IRA contributions. Now, in order to make an IRA contribution, you have to have earned income. So that's a criteria that you have to have, whether it's through wages or self-employment activity. The amount is $7,000 per individual. If you're age 50 or older, again, we know what your age is based on the input we had talked about in week one. It's going to get another $1,000. You can do up to $8,000 for deductible IRA contributions. You can also do a spousal IRA. So if only one spouse works, you can actually have the other spouse make a contribution by leveraging off of that other individual's earned income. We don't see this all that often here in VITA, but it is still a possibility. You could have, again, some reductions or eliminations if the taxpayer does work and is covered by a retirement plan at work. One of the ways you're going to see that is that if you take a look at the W-2, box 13 will have a check mark in there that says retirement plan. What that basically means is that individual is covered by a retirement plan. Usually the W-2 will pick that up as well if they're making a contribution of 401k, 403b, but we just need to double check that. IRAs are a very fantastic planning technique. A little bit later on tonight, I'll be talking to you about the healthcare marketplace coverage and a couple things that relate to that, including some of those advanced premium payments that help offset tax or your monthly healthcare insurance. One of the downsides, every once in a while, we have an individual that has changed their income substantially from the original estimate when it comes to creating that credit. So unfortunately, we've run into some scenarios. We'll talk about that toward the end of the evening here, where people end up owing a lot more tax than what they had anticipated doing. One technique that I've used, and I've actually used this very effectively, a couple years ago, I had a client coming in through the VITA program, and I was working with them on April 15th in the evening. And I will hopefully make sure that no one is scheduled for April 15th in the evening to continue to do returns. But they had been a long-time client, and I thought we'd help them out. The two individuals had come in, And what we're going to take a look at here is they had both needed their return done. The one sister said, "Go ahead and take care of my sister first. I'm sure she'll be more complex." Should have been my first warning that there was a problem. The second individual, the sister, once we were done with the first one, had given some information. Her husband had just passed away the prior year, very unexpectedly. She ended up taking some distribution out of a retirement account, which actually increased her taxable income, which unfortunately created a tax consequence because now her income was higher than her original estimated premium tax credit. So now, because her income was so high, she was above a 400% payback limitation, 400% of federal poverty, and we ran into a problem. She would have owed thousands of dollars to the IRS. Well, the good news is she kept the money she had taken out of the her husband's retirement plan. So we'd taken some options here and said, well, can we put that money back into a IRA? Now, fortunately, she was also 50 or older, so we got an increased amount. So here we are, April 15th at 6:30 at night. All the banks are closed. Her phone's dying. Her phone's also cracked, so we're scratching ourselves trying to get into our apps to get things working. We finally got into one of her bank accounts to be able to set up an IRA. We got that done before the end of the day, so it does allow for a deduction. That allowed us to take the IRA deduction to reduce her taxable income enough that reduced significantly the payment she had to the IRS. So effectively, we were able to kind of make lemonade here out of lemons and get her back into her retirement account by eliminating a huge payback to the IRS. All right, so you can make deductions up until the due date of the return. And as I mentioned, we do want to double check to see if someone's covered by a retirement plan. So I see a question coming in on chat. As a 401k with matching dollars by an employer considered a employer's retirement plan? It is. So if a individual is either actively contributing, we'll see the check mark on the W-3 or W-2 box 13 to say retirement plan participant, or even if money were allocated to that employee, even if they did not participate, that's still considered participating or covered by a retirement plan. Now, again, it shouldn't really impact VITA too much because that threshold's fairly high, but just something we want to keep in mind and fill out that W-2 as you see it completed. One other area I wanted to talk about here are student loan interest deductions. So we do see a number of these. A little bit more information on E17 of your 4012. So a student loan interest deduction is going to work for a qualified student loan. That means a loan that was taken out for the taxpayer or a spouse or a person who was a dependent at the time of the loan. It has to be paid back within a reasonable amount of time of receiving the loan, also taken out for an eligible student, meaning they were at least half time at an accredited school. Here, when I teach for E-Town, we do have verification of attendance to make sure that students are maintaining their half-time status, which is important for student aid and loan activity. Generally, what will happen is the individual is going to receive a Form 1098E, which is going to indicate the amount of student loan interest paid for the year. Now, the deductibility is going to be the lower of the actual amount of interest you paid during the tax year or $2,500. So you can add up all the 1098 E's, go ahead and put them in the return, and it's going to automatically cap it at $2,500. Now, I do want to kind of mention here again, there's some just gross income limitations. It will not apply to VITA individuals. We are all beneath those AGI thresholds, so we're going to be good to go within the VITA program. A couple other things we want to take a look at is you cannot file married filing separately and take student loan interest. That's not going to work. The individual may not be claimed as a dependent on another's return. So where this may be a problem, we may have a student who is still in school. Maybe they're paying back some of their student loans. If they are taken as a dependent on someone else's return, they may not take the student loan interest deduction. So the question is, okay, well, what happens if maybe the parent pays a loan? Can the parent go ahead and take the interest? They could, but there is a big caveat, and we see it bolded and highlighted here, that is legally obligated. So in order to take the student loan interest deduction, you have to be legally obligated. When you get the Form 1098, it's generally made out to the first person on the loan. But legally obligated means that that individual who's paying the loan would have to be responsible either as a guarantor or maybe a cosigner on the loan. So you do want to check with the taxpayer to see if they're legally obligated to pay the loan. We have had questions come in that a client of VITA may have come in and say, Well, I wanted to help pay my grandchild's student loan, so I just made some payments for them. Can I take the loan interest? Unfortunately, unless they are legally obligated to pay the loan back, the grandparent can't actually take that deduction. However, the amounts that are paid can actually be given effectively to the individual who was legally obligated. We treat it similar to a gift. There's no reporting obligation through VITA, but the person who is legally obligated to pay the loan can take that as an interest expense. Again, the loan proceeds have to be used for qualified college costs. That includes tuition, any other higher education costs, so fees, books. What's nice is that it also includes room and board. So if someone takes money out for college, it does include room and board, which is one of the few areas we see here for education. That's going to be a little bit different when we talk about our education credits. Okay, how are we doing so far on the world of deductions? Any questions we're seeing here? All right. Now, I do like deductions. I don't want to diminish deductions. They're great. They help us reduce taxable income, but it does help reduce taxable income dollar for dollar. So if a taxpayer has a 10% tax rate, they get a $300 deduction for educator expenses. They have a net benefit of about $30 to them. What we're going to take a look at next for the majority of our session are credits. So credits are even more powerful. So while a deduction can reduce your income dollar for dollar, a credit's going to reduce your tax liability dollar for dollar. So a credit is much more powerful than a deduction. And I'm going to mention a couple ones here that are going to come into play for VITA. The first one we're going to have is the foreign tax credit. Again, G8 of your 4012. Generally, a Form 1116 will not be required. And the reason why is because most times we're going to be seeing our area here within foreign tax credit is if there is a form like a 1099 INT, more specifically, probably a 1099 DIV or a Schedule K1, technically Schedule K1 out of scope. But we may see individuals that have investments in foreign corporations, and that foreign corporation may have to pay foreign taxes on dividends or other activity. So if you get a brokerage statement and you see that there is foreign taxes paid, and if it's $300 or less, or if you're married filing jointly $600 or less, and we entered it in exactly as shown on the 1099 INT, again, more specifically the 1099 DIV, then that's going to actually generate and automatically create a foreign tax credit. So again, it has to be less than $600 married filing jointly or 300 less for singles, and that will actually generate a foreign tax credit. Okay, let me take a quick look here at our chat. We did have a question coming in about student loan interest for interest paid by a parent when the student who is less than the 25 age, if the student's not required to file on their own. If the kid's a qualifying child, the parent has to be legally obligated to repay the loan. So generally, the parent has to be a guarantor or a cosigner or some other way obligated to pay that loan. If they are, then the parent can take that. If for some reason the parent's not the guarantor and the child really isn't filing a return, then we don't get to take a interest deduction for that year. Uh, Generally, we'll probably see that most parents are probably co-signing or guarantors. So we just want to double check that if that's the case, then the parent could take that student loan interest on their return. Again, it all depends on who is legally obligated to repay the debt. Okay, I'm glad that we brought up the question about a qualifying child because the one thing I love, Rob, when we take a look at definitions, I've now used the same word child. I've used that for dependency exemption. We've taken a look at the concept of a qualifying child being under the age of 19 or under the age of 24 and a full-time student. We're going to keep using that name of child. We don't change that definition, but we're going to change how we use it. And I'm going to talk about that very specifically here when we talk about child and dependent care. Again, G12 of your 4012. I do apologize for this session. We're going to be bouncing all over the alphabet here when it talked about the 4012 in different areas. So the credit is no longer refundable. It had been shortly after COVID that we had a portion of the child and dependent care refundable. It is no longer there. So when we talk about non-refundable credits, it basically means you can offset your tax liability. But once you hit 0, then we can't go anymore. We do have a back to the reduced maximum qualifying expenses. Again, they were bumped up a little bit shortly after COVID. They're back down to $3,000 for one child or dependent care, or $6,000 for more than one. So the credit can range from anywhere from 50% down to 20%, depending on AGI. The AGI phase out's going to only be above $400,000, so we don't need to really worry about that for VITA. So the good news is that we have a lot of opportunity there to take the child and dependent care credit. One word of caution, we do want to take a look at that W-2. If the individual has something reported in box 10, they can actually have up to $5,000 of pre-tax money set aside for dependent care. So if they do have an amount in box 10 of this Form W-2, we definitely want to make sure that that's included in our area and the input, and that'll actually flow to the correct forms. So the child and dependent care form is going to be on the Form 2441. And I just want to go over some of the eligibility rules here for you for this credit. So the care has to be for one or more of the following persons. So first, we're going to do a qualifying child. I'll come back to that in just a second. It could also be for a dependent of the taxpayer who's physically or mentally incapable of taking care of themselves and has the same place of abode for at least half the year as the taxpayer. And that also the third one is a taxpayer's spouse who can't physically or mentally take care of themselves and has lived in the taxpayer's home for at least half the year. And what we define as incapable of caring for themselves is really the position to say that there is some sort of either physical or mental condition that prevents that individual from dressing, cleaning, or feeding themselves or taking medication. We effectively need some sort of care and support for that individual. So it could include a child. I'll talk about what a child is, or another dependent that may have a physical or mental incapacity, or the taxpayer's spouse who's also incapacitated. Now, the definition of child is the same kind of thing, only now we change the age. So now qualifying child is basically someone who can be claimed as a dependent. One caveat here, it's only for the custodial parent. So if you have a non-custodial parent, it's their time to take that child as a dependent. Only the custodial parent can take the child and dependent care credit. So again, only the custodial parent can claim it, the one where the child lived for more than half the year. And now the government has said, all right, if a child is under the age of 13, it makes sense. We need to have care for that child. If they're now a teenager officially, they can raise themselves. They're fine. They are self-sufficient. They don't need adult supervision. Again, according to the IRS, they probably have their own cell phone. They have their own way of how they make their own microwave macaroni and cheese. Don't know if they can clean up after themselves, but they are fine. They don't need any additional care. So what we're going to take a look at is you can have child care costs up to the age of 13. So even if the child turned 13 in 2024. So it's not an all or nothing like all these other ages are. So if the child turned 13 today, say November 21, 2024, we can take all the expenses from the beginning of the year until they turn 13. So while they were still 12, all of those expenses still count. And I just want to go through what some of those expenses include. So that can traditionally be things like before or after school care. It could be things like even camps that they go to, as long as it's not an overnight camp. If you want to send them to soccer camp or Lego camp or computer camp, those are fine. Those are all areas that we can take as a deduction. Now, there are a couple things that we need. First, the taxpayer and the spouse that they're filing jointly have to have earned income. This is an opportunity for people to have care for children or dependents while they are working or looking for work. The other thing we also need to have is a social security number or employer identification number for the individual who is providing care. So we may have a situation where a client may come in and they say, well, I have a child that needs some care before and after school. I have to go to work. But fortunately, I have a neighbor down the street who is very, very willing to help us out. She's great. She makes sure the kids get on the bus. When they come home from school, she takes a look. She'll bring them in her house, maybe give them a snack, help them get started with homework until I'm home from work. Great. Sounds like it should qualify. The children are the appropriate age. This is exactly what we're looking for. All we need to know is that individual's name, address, and social security number. Well, there's the problem. If the individual is not going to provide that information, we cannot take the credit for child independent care. The government's going to go ahead and match up that information that we have on that form 2441, the provider's name, address, and social security or employer identification number, with that provider's return, and make sure that they're going to pick up and report that income on their return. So we may have some individuals that just choose not to disclose that they have some cash activity. Again, we are not going to go ahead and necessarily whistleblow on those providers, but we do want to be sure that we have the rules in place for our clients that they have to have that social security number or employer identification number. If they do not, then we cannot take the dependent or child credit. So generally, how are we going to get this information? Typically, the client's going to have to provide that to us. If they have a kind of a service that they use, or maybe it's a kind of a traditional daycare facility that might have a separate location, we'll probably get a report from the daycare facility that's going to show how much was paid per child. Again, we can only take up to the amount until they turn 13, but those do qualify. Again, it's $3,000 for the first, and 2 or more, we can do up to $6,000 of cost. Okay. Any questions before we move over to our next credit? That's going to be our retirement savings contribution credit. That's going to be found on the G17. And this is actually a very, very great credit for VITA because it's one, automatically going to calculate for the most part. And two, it's very much incentivizing those eligible for VITA or the free tax service here from the IRS to be able to help save for their own retirement. So traditionally, Social Security, when we first established Social Security way back in the mid part of the 1900s, it was a way in order to supplement retirement income. Social Security was not initially designed to be 100% sourcing of an individual's retirement, nor have we kind of planned on people living as long as they're doing. So the government wants to focus on individuals helping to create their own retirement program or their own retirement funding. So the government has created a credit that allows individuals to take not just a tax deductible contribution potentially, but also a credit on top of those dollars. It's a very powerful opportunity to save for retirement. So generally, we're going to pick up this information automatically. If you enter information off the W-2, and I'm going to drop down to the middle part here, if you're making elective deferrals to a 401k, which is going to be a code D, a 403b plan, a code E, or government 457 or a SEP simple, those are all going to show up in box 12 of W-2. So it's going to feel like I'm walking down Sesame Street here, but the codes of a D, an E, an F, a G, an H, which unfortunately is not HSA. That was already taken. HSA's got the code W, but a code H, an S, a double A, a double B, or a double E are all codes that are going to reflect contributions made to a retirement plan. Now, these are all potentially eligible for the retirement savers credit. Also, what could be included is a contribution to a traditional or Roth IRA. Now, the downside is that we don't necessarily have the information. That is not something that may appear generally on a taxpayer document. It's not going to be on their W-2. We may get the taxpayer bringing in what's called a Form 5498. That is a statement of contribution for a retirement plan. Hopefully, they bring it in because they see an envelope that says important tax information on the outside, and hopefully, they're going to bring that in with them. Hopefully, they don't bring all of the mail that they've had for the past 3 months to their appointment and help you determine whether or not it is something that we need for taxes. I'll give you a big hint. If it's a envelope that says Publishers Clearinghouse, you may be a winner. That is not a tax document. If they want to go through their mail while they're waiting, that's perfectly fine. But they may get a document like a Form 5498 that's going to go that should be attached. Just got a question: are they issued sometimes in May after tax season? We have seen these delayed. I have actually seen them come out early in the season. Sometimes you can actually request your broker has that. They do have that information, or they should have it. One of the reasons they sometimes delay that until after May is, again, we mentioned that IRA or even Roth IRA has up until the due date of the return to make the contribution. But you can double check and see, did they have a contribution made to a traditional or Roth IRA account? So 5498 is the only government form we really have that can support that. If they do have a brokerage account or maybe they have an online account, they can download that piece of information or bring in their report that shows how much they've actually contributed. But yet, Richard, you are correct. Sometimes we see these coming in a little bit later, or they may be in a corrected form because now they were able to determine did they make a contribution by April 15th. So the traditional and Roth IRA, we do have to ask, did they make any contributions? If so, then we can add those in manually to that to the input screen for the 8880. Just also want to make sure that you're aware of a couple other rules here. The taxpayer cannot be a dependent or a full-time student. So if they're a dependent on a return, if they're a full-time student, they're not eligible for the 8880. They also have to be born before January 2nd, 2007. Normally, we always use December 31 as our litmus test for marital status, their age for credit purposes. In this case, we're actually giving the benefit to a January 1 baby, someone born on New Year's Day. A little bit of a little unique wrinkle here in the tax code. Again, we're taking a look at some things. I imagine there's a congressperson out there that did not like their gym or health teacher, and that's why they don't give them the education credit or in full or education deduction, I should say. And maybe they're just upset because they were born on New Year's Day. Not necessarily a great day to be born. You kind of miss out. You're kind of a year behind everything else. Uh, on January 1, it's already a national holiday. People already have their own things going on. I know we have some people from the Pocono area. I'm not quite sure how far. Down here in central PA, we usually have a traditional Dutch meal of pork and sauerkraut. Don't know if that spreads up to the Pocono region or not, but you're upset. You have the exact same meal every day for your birthday. Not the best day. But in this case, if you're born on January 1 and earlier than 2007, you can actually take that retirement savers credit. Now, in addition to having to take a look at the traditional or Roth IRA, there's one other component we have to take a look at for the retirement savers contribution, and that is that you have to reduce any eligible contributions by any retirement distributions. So that's coming off a 1099-R that you've taken out literally. So rollovers don't count, but any retirement distributions you've taken in the prior 2 taxable years and up to the extended due date of the return. So you have to ask, do you actually have any prior distributions in the prior 2 years? Generally, we may be able to take a look at the prior returns and see if we have it there. Or have you taken any distributions for the current year? All right. And taking a look at a quick question. Yes, so Ernie, you are correct. Social Security and Medicare both treat someone born on the first day of any month as they've been born in the prior month. Yeah, so we do see that as well. There is that benefit. So, yeah, if you're born on New Year's Day, great. You're counted as actually being born in December. Same thing for April Fool's Day. Probably another not great day to have a birthday. That it's kind of a holiday there that people are going to be pranking you the entire time. But yes, that does move up. So we see that. So apparently, the same person who liked that benefit for the retirement savers credit also wanted that to happen with Social Security and Medicare. One other thing I do want to mention, I know we have this question a little bit here in PA, is for people who work in the education field. You'll notice at times in box 14, there's a contribution to retirement plan called PSERS. So it's the PSERS, the Pennsylvania State Employer Retirement System. So contributions to PSERS can be considered a eligible cost for this contribution credit if they are a voluntary after-tax contribution. So while they may be showing up in box 14, we do want to clarify with the client that it is a voluntary after-tax contribution. So that can either be an additional percentage or some other way that they're making that contribution, but it has to be an after-tax voluntary contribution to be deductible. If you have that on box 14, you can actually drop down and select retirement not in box 12, carry to form 8880. So it is a drop down option in the input section. Probably best when you're working through the W-2 to ask the client, was it a voluntary post-tax contribution? Okay, any questions so far on the other credits? Okay, we're going to mention something here on the energy credit, G20. Good news is that these energy credits are extended through December 31, 2032. Not to say I might not have to update my slides between now and the next 8 years, but good news is the energy credits are going to be around. Now, the downside is there's one part that is going to be outside the scope of VITA. This is going to be our residential energy efficiency property. The reason I'm going to bring this up is maybe not just for clients of VITA, but for preparers within VITA, this may be applicable. So, residential energy efficiency property includes qualified solar electric, solar water heaters, geothermal, and wind turbines. These are fairly extensive credits. They're going to be relatively high dollar items because you're putting solar panels in, you're putting in a geothermal system. I actually have a number of my neighbors here who are going through this process. We have a lot of solar panels going up. My neighbor right across the street put in geothermal a little bit ago. These are very, very important credits, but because of the size, you're actually out of scope for VITA. Where we may see these actually apply is the second part. So again, the form 5695 is our energy credit form. The instructions for the 5695 is very, very important and very helpful to go through here. And when we take a look here, okay, question coming in from Rob concerning a general question going through a screening sheet and other things starting on page G17. So the G17, I think you're referring to the retirement savers contribution credit. Generally, you will just enter the W-2 as you kind of get it. For the retirement savers contribution credit, that's where we're going to have a couple of those additional questions, like did they make an IRA or Roth IRA contribution, and do they have any withdrawals in the prior to or the current tax year? So generally, you're going to kind of follow the W-2 for the most part. There are just a couple things we just want to have you kind of ask as you get into that retirement credit component. So, yep, we do want to follow those. That it probably going to be a slightly different process. Most people probably in the intake sheet aren't going to indicate that they're eligible for the retirement savers credit, something that just kind of populates with our return. Not a whole lot of manual calculation you need to do on that one. I do apologize. But generally, it's going to be predicated off that W-2 or if they have an IRA or Roth IRA. In all cases, they do need earned income. So we're going to find that somewhere coming off a wage statement or self-employment. So it's always good to take a look at some of these forms. Again, if you haven't seen the form 5695, there are a number of things that we have for qualification. Fortunately, there is a $1,200 aggregate credit of $1,200 for building envelope components. What building envelope components include are exterior doors, exterior windows, insulation items, and other insulation systems. You can take up to the 30% of those costs. Or residential energy property includes central air conditioners and includes natural gas, propane, or oil water heaters. Also includes natural gas, propane, or oil furnaces and hot water boilers. So that's 30% of the cost, including labor, up to $600 per component. So you may have a person that went ahead and they did some upgrades to their property. They have some new windows, new doors, a new heat pump. All that can be aggregated together there. So if it's building envelope components and residential energy, you can get up to $1,200. If they have a separate heat pump or a biomass stove, which include pellets and everything else, up to $2,000 for that. So the improvements have to be made to the taxpayer's main home. I don't think we have a problem here with VITA. If someone's coming in and they say, can I use this for my second mountain property? Well, no, it has to be for your primary home. Again, the common ones we're going to see are these non-solar water heaters. So a water heater replacement does count here as a residential energy property. The HVAC systems count, biomass stoves, exterior windows, doors, and insulation. So again, kind of refer back to the Form 5695 for details on what those include. Generally, they're probably going to get a statement from their contractor, which is going to say that they are eligible energy efficient properties. We don't have to necessarily have that. We just need them to provide the cost of the energy property and to certify to us that it does count. But the IRS is going to need that documentation in case they have any questions with that credit. So the taxpayer should have that documentation. Generally, if they have a qualified individual installing these, it should have that delineated fairly clearly. If they're saying, I met someone at the Home Depot in the parking lot and they put in windows for me, where'd you get the windows? So, well, they found them in a scrapyard. They're probably not energy efficient, will not count for the credit. They need to have an actual energy efficient rating in order for that credit to qualify. So, again, the instructions 5694 are going to help out very nicely in determining the amount of the credit. All right, let's go ahead and take a look. So no additional questions coming in. I'm going to hop over to education credits now. So education credits are going to be an important concept. We do see this a bit here within VITA. So there are two main credits available for education. Both are going to be using the uh, the information coming from a student. So we're going to take a look at the basic eligibility rules. We'll take a look here at our different opportunities. I just want to go back here. It looks like something popped in for chat. Here, the 2,000 credit can be used for secondary homes. That works for the $2,000 for heat pumps and biomass stoves. That does not include some situations we have here for a couple of the other energy credits. So I just want to be cautious here for VITA. We're not anticipating our taxpayers within VITA to have more than one primary residence or a second home. So generally within VITA, we can do that as long as it's for the primary home of the taxpayer. The 5695 does have a couple other pieces, some of which are actually outside of scope of our program. Okay. Taking a look here at the education credits again, two that are available. The J section has a lot of information on education credits. That includes a eligibility for the taxpayer, the spouse, or dependents who are claimed on the return who attended an eligible post-secondary educational institution. What do we mean by a qualified, eligible post-secondary educational institution? That is a institution that has received certification from the Department of Education. What that means that it has to be a qualified institution. It cannot be, Sam's pop-up surfing school in California. It can't be some guy out of a little VW bus trying to sell surfing lessons. That's not a qualified educational institution. Not quite sure where the Department of Education is going to go here in the next couple months, but if it's certified, they're be the institution that will certify it's qualified as a post-secondary. So it has to be for attendance at a post-secondary institution. The individual who's claiming the credit cannot be claimed as a dependent on another return. And they also cannot file a married filing separately return. Now, the question may arise, can a taxpayer take that credit? Potentially. Now, there is a income limitation on where this can arise. So generally, that AGI phase out is right around kind of our border as we're hitting middle income taxpayers. So it's definitely under $200,000 a year, kind of changes a little bit. So if for some reason a taxpayer cannot take the education credit, they could theoretically allow their child to take it. However, in order for that to happen, the taxpayer cannot take the child as a dependent on their return. As long as the taxpayer does not take the dependent on their return, then that child may be able to take the education credit. And we'll talk about the credits for dependents in a little bit. But the only reason that may work is if we have one of these education credits that has a refundable component. We take a look at the American Opportunity Credit. There is a very nice refundable piece that the individual may be able to get to $1,000 of education credit versus if the parent cannot take the child as a does not get a credit for the American Opportunity Credit because their income's too high. They might get up to a $500 credit for the individual. So just something we take a look at. Again, just a caution, we probably don't want to prepare returns for students or college students without knowing what their parent is doing. So just want to be very cautious about saying, yep, my parent agreed that I can do it. We just want to double check. A couple problems arise because when we file a return, if for some reason a student inadvertently claims themselves as dependent on their own return, that precludes the parent from going back and claiming them. So we just want to watch when we're doing these returns to make sure that we don't inadvertently file a return as a student who should not be able to claim themselves as a dependent. So a couple changes we have there. Cannot file a return as married filing separately. Some income limitations. Again, those will not apply for our VITA clients. Qualifying expenses include at that eligible institution things like tuition, any related costs required for enrollment or attendance. So this could be things like lab fees, additional student costs, if you have to have equipment for your program. So if you have to purchase medical equipment if you're a nursing student, or maybe need a specified computer or calculator for mathematics or computer programming, those are required expenses. Those can count. What does not count are room and board costs. So while we could use that for student loan criteria, does not count here for education credit. Likewise, any personal living or family expenses don't count. So while someone's going off to college, one of their first things is let's update our wardrobe and buy as many college shirts and sweatshirts as possible. That is not considered a qualifying college expense. That is a personal expense and is not eligible for our deduction here. Another thing we want to take a look at is when we talk about education credits, we're going to find out how much was actually paid during the tax year. So we want to take a look for the 2024 returns. How much was actually paid for things like tuition and those required expenses for the 2024 year? Now, the good news is that if you made a payment in 2024, but it's actually for the following semester. So oftentimes what happens is colleges will start sending out their bills for their spring semester starting now. So they want the students to pay before they come back on campus. But if you pay tuition in 2024, that is going to be for an academic year starting within the first 3 months of 2025, that's still fine. We can still use those costs on the 2024 return. So that might help us get to a couple of these eligible expenses. A couple things I just want to mention here as we take a look here. We do want to go ahead and take a look to see which credit's going to work the best. So there are two that are eligible. The first is the American Opportunity Credit. We only need $4,000 of costs in order to get the maximum $2,500 worth of a credit. So if you haven't priced colleges lately, $4,000 of costs is not a significant amount. This is eligible only for the first 4 years of post-secondary education. So oftentimes what we're going to see is that the first 4 years of post-secondary education will actually cover 5 calendar years. So typically what's going to happen is a student is going to graduate high school generally in May of one year. If they head right off to college, they're probably going to start in August of that year, but they're not going to finish their first full year of college until generally May of the second year. So now we have the first year of education actually covers 2 tax years. Again, the good news is that we can actually use payments made for the spring tuition if they're paid in the first year. That actually works. So we can actually cover this in first 4 years of payments. But once they hit that, after the first 4 years, they can no longer take the American Opportunity Credit. Again, the expenses that qualify are going to be things like their tuition, their course materials, your book supplies, and equipment needed for the course of study. The great part about this credit is up to 40% can be refundable. So when we have a $4,000 eligible cost, we're going to get 100% of the first $2,000, and then we get 25% of the next $2,000. So up to a total of 2,500. Up to 40% of that credit is refundable. So if you're qualifying for 4,000 of cost, you get the full $2,500 of credit. Up to $1,000 can be fully refundable even if no tax liability exists. So that is a incredibly powerful benefit. Now you have to be enrolled in a program that leads to a degree or certification. So it has to be some sort of vocational or college degree type program, at least 50% of the normal full-time workload. And how do we determine that? Generally, you should be getting a Form 1098-T from the institution. The Form 1098-T is going to have a lot of great information on it. It's going to show the institution's name, address, EIN, which we all need to put in on the education credit form. It's going to hopefully show how much they paid in tuition in box one, reduced by any amount of grants or scholarships received. It's also going to show a checkbox whether or not they're at least a half-time student. So the Form 1098 is going to be very important for us to work from. Example, that's going to be on the J11. We may need a little bit more information as well. Sometimes they may bring in their financial statement or their bursar activity, which will show the actual payments made and what they were used for. One very important part, this is one of our most bizarre questions we have in TaxSlayer. or at least in the whole tax preparation process, is in order to take the American Opportunity Credit, again, we need the first 4 years of education. You have to be at least half-time enrolled in a program that's going to lead to a degree or certification. And you may not have a felony drug conviction by the end of the year. Any other felony conviction is fine. So again, apparently somewhere in the negotiation process of this American Opportunity Credit, some senator or congressperson said, absolutely not do we want felony drug convicts to be able to get a credit for education. If they had a felony conviction for racketeering, murder, grand theft auto, extortion, that's fine. That's okay. That's not going to preclude them. We believe they deserve a second chance, but felony drug conviction is not eligible for the American Opportunity Credit. So unfortunately, a question we do have to ask, it may just be, just want to go through another question I have here. Was the student convicted of a felony drug conviction by the end of the year? Couple keywords. It's a conviction. So they have to be actually convicted. If they were charged, that's okay. It has to be a conviction. And it has to be a felony. So there's a difference between a felony and a misdemeanor. Hopefully people understand if they were convicted of a felony. We don't need people coming in, VITA, and talking about their past criminal history and determining whether it's a felony or a misdemeanor. They should know if they're a convicted drug felon. So that's generally for possession or distribution of a controlled substance. Now, even if they are, I haven't had any clients that have told me they have a felony drug conviction, but even if they are, all is not lost. They still have the opportunity for a lifetime learning credit. This is a credit that you can take much less restrictive than the American Opportunity Credit. This is up to $2,000 of a credit. You get 20% on every dollar of qualified cost for the first 10,000. So again, if it works out great for an individual who might be on that 5 to 8 year plan to get their bachelor's degree, might be great for people who are in a graduate program getting a master's or a PhD. There's no limit for the number of years that this can be claimed. So while the American Opportunity is for the first 4 only, lifetime learning, we have an unlimited amount of years. Now, again, predominantly it's going to be our tuition. Any course-related books, supplies, or fees or equipment are qualifying costs only if they're bought through the institution. So we cannot buy these things through Amazon or some other place. They have to be acquired from the institution. Again, no requirement for half-time enrollment. So this works out great for people who might be going back to school, taking up a couple credits at a time. And a felony drug conviction does not preclude the credit from being taken. Again, important to get that Form 1098-T. That's going to show that the student actually was enrolled on at least a half-time basis and provide the information we need to complete our credit form. Okay, any questions so far?
Jared,
Yes,
question
yeah,
on the comment about course-related
yeah,
books. In some situations, universities direct their students to go to Amazon to purchase their books.
right. Yep,
Would that be, that's not purchased from the institution, would that
correct.
still be eligible?
That would not. So that would be
It-
eligible for the American Opportunity Credit. So it doesn't really matter where you buy your books or supplies as long as they're needed for the course of study. So the American Opportunity Credit is fine wherever they're purchased from. However, for the lifetime learning, they have to be purchased from the institution. So that's one other little difference we have between those two credits. They actually have to go ahead and purchase those from the institution.
Okay, thank you.
Okay, looks like we might have another question coming in on chat. Okay. Oh, I'm sorry. Yep. We actually have the hand up there as well. So, yeah, feel free to go ahead and unmute yourself, or if you want to do it in chat, either way.
Hey, Jared, how you doing today?
Good. How are you doing tonight? How are things up in the Pocono region?
Oh man, wet right now, but they saying the snow might come in. I'm hoping not. But we'll see. Jared, I want to go back to the criminal conviction for drugs.
Yes, sir.
Okay.
Yep.
As you may or may not know, Pennsylvania actually, I believe, signed into law that anybody who was convicted of a felony for like marijuana possession, that those would be automatically expunged.
Yes.
So if it was expunged, do we now get to say no on that and allow them to get their AOC?
That is correct. Yeah, any expungement has basically now kind of reversed that conviction, if you will, from a legal standpoint. So we can legitimately say it was not a felony drug conviction. That would be for people who were convicted under Pennsylvania statute, I believe. Is that your understanding as well? It's not a federal drug trafficking case, but it would be for a felony under PA rule.
Correct. That is. And now my next question, I guess, so the expungement, it was signed into law, but I'm not quite sure if it's like just blanket. Oh, okay, everybody who was, or if they actually have to take some steps and get a certification of the expungement. Is it
Right.
does it fall to us to ask for clarification or documentation? I mean, I'm sorry.
Yeah, no, that's a great question, and certainly one that we're trying to take a look at because it's a relatively new process here. So, no, great question about what happened. So, while they had a conviction, any type of expungement, any type of so even technically clemency would also go ahead and go ahead and overturn a conviction. So we will generally take the taxpayer's word that they've been expunged or that they should hopefully be aware of any other additional steps. Usually, a general into law expungement would basically be there's no other need for action by that individual. It should automatically be erased from their record. So that should automatically happen. Again, we can kind of take a look at that. Yeah, and hopefully that if it becomes an issue, they should hopefully have documentation by time if an audit were ever conducted. But again, I think the expungement for particularly the marijuana-based crimes should be pretty well allowing us to officially answer that question is no. They do not have a current felony drug conviction because it's been expunged.
Thank you.
Yes, sir. Okay, it looks like we have another question, Dolores.
Hi. If someone, for instance, was going to real estate school,
Yeah.
would that be considered an accredited institution?
That are you talking about kind of where the real estate companies may offer a program and then
You have
set in
continuing
for this?
ed and
Yep.
different things that you have to go through.
Yeah, that typically is not considered a post-secondary education that is granted status by the Department of Education. Those are generally kind of more of a continuing education program. So while it's leading to your continuing education credits, it's not generally one that's going to be approved by the Department of Education that leads to a degreed program. That's kind of what we take a look at for a qualified institution.
So that
Yeah,
would not
Jared, if
fall
I
into
can jump in, it
lifetime.
has
You
to
would have to
lead to a
take that off on the
degree.
Schedule C if you made money.
Correct. So yes, so that would be if you're doing continuing education. Great point. It would be allowed as a deduction for continuing education for a Schedule C. So realtors obviously have to take continuing education. And what we're going to take a look at, particularly if you are involved in areas that other areas that might have attorneys, even our accounting have continuing education. Those would not be considered education credits but instead deductible for earning your income. So I'm sorry, Mr. President. I think you may have had a comment there as well.
No, I was just piggybacking off of what you were saying. It has to lead to a degree, an associate's, a bachelor's, master's, or post-secondary degree. It actually
Correct.
has to lead to a degree, and an accredited institution is one that actually has a certification from a state as an accredited academic institution.
Correct.
But it leads me to a question. So you have these nursing schools now. Okay, when somebody graduates from a nursing school, that's like a 2-year program. Is that considered an accredited institution, Jared?
They generally would be if there's some sort of degree coming out of it. So whether it's a associate's degree or whether there's some sort of certification of a nursing practicum type certification, generally should allow that. Again, that's one of the reasons why we'd love to see that Form 1098-T. The only one that's going to be issuing those are going to be qualified institutions. So ones that they're going to be accredited. So in chat, there was a great comment that you can actually look up for the Department of Education, assuming that they're still going to be around by the time we're preparing returns next year. You can look up at www.ed.gov and determine whether or not that institution is accredited.
Thanks,
So
RG.
yeah. So Dolores, going back to your question, usually continuing education may not be. Those are generally people who do consulting work that qualify for state-based qualifying education. But you can always double check to see if they have gotten their certification from either the state accredited bureau or through the Department of Education. Okay, great, great. Always good to have some discussion. I always love having that opportunity to help answer some questions as well. So a couple other things we want to take a look at. Again, deductions are good. Non-refundable credits are really good. If we're in New York, I think we call it more better. But here, if we have the ultimate one, are refundable tax credits. These are great because what they're going to do is that they are going to give us money back to the taxpayer, even if they do not have a tax liability. So I'm going to mention two of our most popular ones here, the child tax credit and credit for other dependents. So we'll get more time in there. Also, the earned income credit, our most powerful credit, particularly for people that are eligible for VITA. And just want to make another quick mention here about estimated tax payments. Estimated tax payments, if you have an individual who knows that they owe taxes each year and they have set up estimated tax payments, we can enter them into TaxSlayer. Where I typically see those might be individuals who might be retired. While they may be able to control some withholding off their retirement plan, things like Social Security generally do not have withholding. You can have it if you want, but a lot of people choose not to. So they may instead pay estimated tax payments. If they've made any, generally they're going to tell you. We can also help them make estimated tax payments for the following year. If they have estimated tax payments, we just have to enter that into the TaxSlayer system. Great point on H7 of your 4012 of how to do that. Also want to mention just one other thing before I head into credits that just kind of struck my memory here. We had talked last time about the Form 1099-R, just kind of hit me here as we were talking about why people may have tax liability. We talked about a couple exceptions to the penalty for early withdrawal. That was going to be the Form 5329. We mentioned a good amount of those codes that could work. We went through a slide. There is one that is brand new that has just been added to the 4012, which is called the emergency withdrawal from a retirement account. So in your 4012, if you go back to that section where we talk about coding, there is a new line, line 23, that allows for people to take money out of their retirement account prior to reaching retirement age, but it would be not subject to the 10% penalty if they're taking out for purely emergency purposes. So what's an emergency? An emergency is not like I just saw a great flat screen TV on sale and I have to have it. That's not an emergency. But emergency could be repairs to your home, going ahead and taking payments out to make sure that you can pay rent or offset a mortgage payment, medical costs, that type of thing would be considered emergency. So the reason why I bring it up is we're seeing that there are some questions that might be popping up on the exam that deal with how do we handle emergency withdrawals from a retirement account. Still taxable, but not subject to a penalty. Okay, so I want to talk about a couple other things here, some of these really, really exciting credits that are refundable. Here we are back again in the world of child. So we've talked about child. We've talked about in the context of a qualifying child for dependency purposes. That was a child. We had a different age range, under 24 if they're a full-time student. We talked about a child for child care credit purposes under the age of 13. And now we have the child tax credit. So on G4, we're going to talk about the child tax credit. We've seen some iterations over the past couple of years. Right after COVID, we had a little bit of a higher amount available. We also saw some changes based on ages. Again, it's going to be under the age of 17 at the end of the tax year, up to $2,000 per qualifying child under the age of 17. So if I'm looking at the government's logic here, at the age of 13, the day you become a teenager, you no longer need someone's care before or after school. You're perfectly able to bathe yourself, dress yourself, take care of yourself. You're still a child, though, for dependency purposes up until the age of 23 if you're a full-time student. But apparently, if you're under the age of 17, you cost more money than when you turn 17. So obviously, parents should not need any more money for their children because once they hit the age of 17, they don't really cost much money. Well, that's the government's view. So they have to be under the age of 17 at the end of the tax year. Once they reach age 17, they're going to lose that that $2,000 credit. One of the main reasons we see some individuals have a drop in their refund from year to year is because they may have a child who is now aged out of this child tax credit. So we're going to talk about what happens once they reach age 17. You still get a credit potentially, but that's going to drop from $2,000 down to $500. That's a $1,500 swing in the credit. And also, this is refundable potentially. So we could have a fairly substantial drop in refund as these children get older. So again, they have to be under the age of 17. They have to be a U.S. citizen, a U.S. national, or resident alien. So unfortunately, we may have some issues if we have some in Lancaster County. We have a lot of refugees, and we do returns for. The child has to be a resident alien at the time that we have the return filed. They also have to have a valid social security number by the due date of the return. The child must be claimed as a taxpayer's dependent. So in this case, the non-custodial parent can still claim the credit. That's going to follow that dependency exemption. So if the parent is able to claim the child as a dependent, they get to take the child tax credit. As a reminder, the child care credits only by the custodial parent. Again, the child has to have a valid social security number by the due date of the return. So if we have someone who may have had a birth of a child at the very end of 2024, we have to wait to file that return until a social security number is issued by the government. Shouldn't really take too much time to get that done. I do work with some Amish people down here in Lancaster County, and they get their social security numbers back relatively quickly if they're having birth at a hospital. If not, they have to go through a little bit longer of a process. But hopefully, social security numbers are all obtained by the time we file the return. Otherwise, you're not eligible for that child tax credit. Good news is there's actually an additional child tax credit opportunity. I do want to remind you, this is automatic. So what's going to happen here is that if a taxpayer has earned income more than $2,500, the credit's going to be based on the smaller of, and I do apologize, you don't have to memorize this. This will not be tested, but just shows you how we come up with math for tax returns. Going to be based on the smaller of 15% of the taxpayer's earned income over $2,500 or the amount of unused child tax credit. Again, these are automatic calculations within TaxSlayer, so they have to have earned income over $2,500, or they can also qualify with 3 or more children. So if 3 or more qualifying children, they're automatically going to be in that additional child tax credit category. So talking about a couple things for the children. So they, again, have to be under the age of 17. But if they're 17 or older, they can still qualify for the other dependents. Most common ones we see here are children age 17 and above. So they're qualifying children on the return, but they're no longer qualifying child for the child credit. They can still get up to $500 for the other dependents if they don't qualify for the child tax credit. It could also apply for individuals who might be a qualifying relative. Again, the qualifying relative test can come into play here. We sometimes see it in VITA that we have a elderly parent that can also get that $500 other dependent for. So the dependent cannot be, again, qualifying as a qualifying child for anyone else. We still apply those dependency rules from the qualifying relative chart. Again, they have to be a U.S. citizen, national, or resident of the U.S. The residents of Mexico or Canada do not qualify for this credit for other dependents. And again, they have to have their identification documents, either a social security number, an ITIN, or an ATIN by the due date of the return. So again, $500 for anyone who doesn't qualify for that child tax credit, and a couple other restrictions there. Okay, heading into our most effective tax credit is the earned income credit. More information here on I-3. Okay, additional child tax credit refundable. Yes, so the additional child tax credit becomes refundable. So the child tax credit generally at this point non-refundable, but that additional child tax credit piece becomes refundable. So it is a great way for people who may have already offset all of their taxable income to get some additional money back from the government? Great question, Barry. I appreciate that. Earned income credit, again, on the I-3. I very much like this credit for a variety of reasons. One, provides a lot of benefit here to lower income earners. And I love it because the government actually tells us exactly what it is. So the title earned income credit means it's a credit if you have earned income. That's our primary qualification. So earned income would be things like wages, self-employment, business income are two most popular. But we can also get earned income in a couple other ways. One is if we have taxable long-term disability benefits, if we're getting those prior to minimum retirement age. So we can make an election to have long-term disability retirement benefits as treated as earned income. I'm also going to go through another example a little bit later on today about Medicaid waiver payments. Those can also be considered income for earned income credit purposes. And our last session here this year, we're going to talk a little bit about military. So combat pay, generally non-taxable for federal purposes, but you can make an election to treat that as earned income for earned income credit purposes. The investment income cannot exceed more than $11,600. I think in VITA, we're in pretty good shape with that. That would be $11,600 of investment income, including things like interest and dividends. It cannot exceed $11,600. That actually has gone up from the prior year. Again, it cannot be married filing separately. Taxpayer and spouse must have a Social Security number by the filing date of the return. And children also have to have a Social Security number to be treated as qualifying. If you have a child that does not have a Social Security number, we cannot treat them as a qualifying child for purposes of earned income credit. So they can still be on the return. We may still be able to have a couple credits that apply. In that case, it might be, we have to hopefully get an A-10 or an I-10 to get them to get the other credit for dependent. Again, they cannot be a qualifying child of someone else. And the big thing the IRS does double check on is was not previously disallowed in a prior year. So if an individual had an issue with the earned income credit in a prior year and the government's not allowing them to take it, you will get a diagnostic coming back when we try to file. They might have an opportunity to maybe work with one of our legal resource centers. As we talked about last time, we have MidPenn here in the region that might be able to help them work with the IRS to get back on track for the earned income credit. So the child, for purposes of earned income credit, has to live in the U.S. for at least half the year and be a U.S. citizen or resident alien for the entire year, and again, have a Social Security number. So the qualifying child rules, very similar to the dependent rules, except we don't have to worry about the support test. And again, as I just mentioned, they have to live with you for more than half the year here in the U.S. Qualifying children are going to be important because when we take a look here at these charts, and I actually put those together here for you in the slide deck, we're going to talk about what happens when we take a look at your amount of qualifying children and your amount of earned income. If you do not have a qualifying child, and again, we have to meet the qualifying child rules, and they have to have a Social Security number, then you have to actually meet an age test. So the taxpayer has to be at least 25, but under 65 as of December 1st. You can still take it without a child as long as you meet that age test. If your earned income is under $18,591, you can get a maximum tax credit of $632. Do not memorize any of these numbers. They change each and every year. I just want to show you for purposes of these charts, typically that all the VITA clients may have the opportunity to participate because we do not have an amount that exceeds our VITA criteria. But what happens once we add a child or two? So we'll see what happens. We add one child. Now that income goes from $18,591 all the way up to $49,084. And again, this is for singles, head of households, and qualifying widow or widower, which we call qualifying surviving spouse. So not only did we just add about $30,000 worth of income, but that credit also bumped up by about $3,600. If we add a second child, we're up to now $55,768, and that credit goes up to almost $7,000. If you have 3 or more children, we're just under $60,000 of earned income. And taking a look here at the maximum credit of just about $7,800. So a fairly substantial amount. Now, I do want to mention that if you're married filing jointly, that does bump up a little bit. So we're basically going to take a look at those earned income thresholds there. So they do increase a little bit higher than just a single individual. But the maximum credits are still there. Now, the IRS does not publish exactly how much income you need to get to these credits. It's all built into the tax software system. So we do not need to go ahead and worry about what that looks like. Here in our United Way program, we have not had individuals that have tried to abuse the system. But the interesting part is theoretically, if you could figure out how much earned income do you need to maximize your credit, and the way this calculation works is it's like a bell curve. We start off with a very low credit initially, goes up to a much higher amount when you're in the middle range, and then starts declining a little bit as you get closer to these income thresholds. So the IRS has had problems in the past where individuals have effectively made up income, that they have a cash-based business, they don't have any deductions, and an individual comes into a site and says, I have exactly $18,317 of income that I'd like to report. I have no expenses, and that is the amount that they've calculated will maximize your earned income credit. We don't really have that. We haven't had any issues yet here. We've had anyone try to get through the gatekeeping system, but the IRS is concerned about fraudulent earned income credit claims. So they do have the ability to preclude people that have been found doing this in error or intentionally for a period of years. So that is one of our most popular credits. That is really going to help out with our individuals coming in for free tax preparation. Has really put a lot of money back in the pockets of people who need it the most. Again, the government enjoys this opportunity because it is rewarding people who have earned income, but not a lot of overall income. So it's going to be helping effectively the individuals who are trying to have earned income, but still need some assistance. So just want to kind of mention that is the credit opportunity there for the earned income piece. Okay, so I wanted to go ahead and take a look. Any questions so far on earned income credit? Okay, one other thing I just want to make a quick mention on here, Medicaid waiver payments. These are found on the D12 of your 4012. What that looks like is we may have individuals here in PA, you have the ability to go ahead and take a look at the process here for receiving payments under Pennsylvania Medicaid. That allows you to provide non-medical care for eligible individuals. That would be that sometimes what may occur is that you have a relative who is receiving Medicaid payments and they need some additional care. Medicaid can actually pay you to be in the home and assisting them with some of their functions as long as it's a non-medical treatment. So if that happens, the income that you receive is actually not taxable. So in that case, you will not have to report that income on your federal return, but you may have the ability to go ahead and include those Medicaid waiver payments as income for earned income purposes. So again, D12 is going to walk you through that process. If you have any questions with that about the Medicaid waiver process, you can take a look at Notice 214-7. Has some more information about the Medicaid waiver process. Okay, any other questions here on credits? I'm going to switch over to itemized deductions real quick, just for a little bit, and then come back and talk about the Affordable Care Act. Now, the good news is I asked our individuals today at our VITA training how many people have dealt with itemized deductions, and the answer came back 0, that we're working with itemized deductions currently within the VITA program. The reason why is because when we take a look at itemized deductions, we get the benefit for the taxpayer of the higher of a standard deduction or the itemized deduction, whichever one's higher. Now, we've had fairly substantial itemized deduction changes in the past couple of years, but we've also had a very high amount of standard deduction for the past couple of years. So we're seeing fewer and fewer people actually having itemized deductions. There are a couple, I just want to mention that here on F5. The very most common ones that are deductible within VITA scope are medical and dental expenses. I'll go over another quick sheet with you here in just a second. But in order to get medical and dental expenses, you need over 7.5% of your adjusted gross income. So highly encourage you, if someone comes into your site and they bring a shoebox full of co-pays and receipts from their pharmacy, we are not going to spend time going ahead and adding those up. If they have a list, if they have added up, that's fine. But generally, they're probably not going to itemize deductions just based on medical and dental costs. Where we're going to see a lot of those medical and dental, where it may make sense, I've seen it more in my practice where we have people who are paying fees for entering a retirement or nursing facility, or they may have a large amount of long-term care insurance expenses, that type of thing. That's generally where I see the medical and dental helping in an itemized situation. A couple other things we're going to see. There's a very strong lobby among home builders. So we're going to see a very strong opportunity for homeowners to qualify for itemized deductions. That includes home mortgage interest, also on a Form 1098, a home loan, or even a home equity loan can be deductible. Now, in order for a home equity loan to be deductible, we have to use the proceeds to buy, build, or improve the qualified residence. So it has to be used for the building itself. It can't be that we're taking a home equity and going on vacation or paying down other debt or buying a car. It has to be used for the home. Mortgage insurance premiums, we put this down. Every once in a while, it comes back. It has not come back for a little bit, so I'll probably take that back off. But that still can be found on the Form 1098. Real estate taxes, we do have the ability to take those. Again, that could be a situation here for the homeowner. Usually that's a fairly high expense. That can be considered a deductible opportunity for itemized deductions. Combined with state and local income taxes, we do have a cap. Currently, that's $10,000 total taxes. Real estate, state and local income tax, or sales tax, we take that instead. So again, we may not see a whole lot of people just itemizing. If they don't have a mortgage anymore, they just have real estate tax. Again, we probably won't hit more than the standard deduction. All those are going to be lower. Question coming in here about itemized deductions. Generally, when we do the interview, we try to just find out exactly how much they may have. Some of these documents may be like the Form 1098 are going to be coming in from the taxpayer. That may give us an indication of how much that's going to look. Before we spend a whole lot of time going through it, if they just have a handful of medical costs, the standard deduction is pretty good. Some of the larger ones, we may not see it here in VITA as much, but gifts to charity. You do need to document your charitable contributions. Those have to be basically supported when we get to an IRS exam. The taxpayer is going to be responsible for the documentation. Generally, the IRS wants to have what they call contemporaneous acknowledgement of a gift. So if you give money to charity, hopefully they give you a charitable gift letter that acknowledges that they made a contribution and the charity has received it. One of the other ones that we have on here that I've unfortunately used here in VITA is these gambling losses. So if someone has lost a substantial amount at their gambling, they can actually get into a itemized deduction scenario. But again, most times we're not going to really see this occur. The main thing we basically have are going to be here for home ownership, maybe gifts to charity, maybe large medical expenses. So interview tip, we may just want to ask, do they have any substantial deductions? We have to remind taxpayers of those documentation rules. So Rob, going back to your question there about how do we handle those, maybe just a quick inquiry to see if they have any substantial deductions for charity, any large mortgage interest payments or medical dental costs, that type of thing. Looks like we have a couple questions popping back in here for the Medicaid waiver payments. So yes, so Medicaid waiver payments are considered earned income for the earned income credit calculation. But those, I believe, Ernie, are still exempt for PA and local earned income tax returns. So not considered earned income for those areas. And I will clarify that for state and local purposes at our next session about Medicaid waiver payments. But yeah, Peggy, they are eligible for earned income credit earned income portion, not taxable for federal, but we can use that for earned income credit purposes. Okay, as we get close to the holidays, in fact, we won't be meeting next week due to Thanksgiving, but we do have some information on medical costs. So on F8 of your 4012, medical costs that could qualify would be for the taxpayer, the spouse, any dependents, any individual who could be dependent except for the gross income test. If they have more than that $5,070, I believe is what our new threshold is, if they can be claimed as a dependent of another. So, for example, if you can't claim your child on a return because the other parent might be claiming them, you can still make medical cost payments for them and treat it on your return. Now, types of unreimbursed expenses include your medical costs. That could be doctor's visits, co-pays, could be dental costs, could be vision costs, eligible long-term care premiums, medical mileage driven. So, unfortunately, if you have to drive for treatments, the medical mileage can be a deduction as well. And I just want to highlight prescribed medication and programs. So medication must be prescribed by a licensed U.S. doctor and allowed to be purchased legally in the U.S. So we just want to be cautious that we have the correct amount of medical costs going through. It has to be legally prescribed and legally purchased. So that means if someone's going through a online pharmacy from Canada or Mexico, those are not deductible medical costs. The reason why I bring up we're close to the holidays here on F8 of your 4012 is a great list of what is and is not deductible for medical expenses. So if you're running out of ideas what to do with friends and family that might be over for the holidays next week, you run into a little bit of a lull. Maybe they've gone through all your board games that you have at the house. There's nothing good to watch on TV. You may want to start a game, just deductible or not deductible, and go through some of those questions on the F8 of the 4012 to determine which medical costs can be actually claimed as an itemized deduction if you are higher than 7.5% of your adjusted gross income. So just want to mention the 4012 has a couple other benefits as well. Okay, want to switch gears here and talk a little bit about the Affordable Care Act. I do apologize. There's a number of slides here and a number of pieces within our 4012 talking about the Affordable Care Act. Just want to give you some salient highlights, particularly for people who may not have seen this before. This only applies for taxpayers who bought their insurance through the marketplace. And when we mean marketplace, we mean healthcare.gov or penny.gov if they got it through PA. If they bought their medical insurance through the marketplace, and again, we may see a good amount of these within VITA, particularly for individuals who do not qualify for employer-sponsored health care. Maybe they have a number of part-time jobs, or they haven't met full-time requirements, or they're kind of waiting for a enrollment period to start. They can have insurance through the marketplace or penny. Again, you'll probably see a lot of commercials coming in that were at that time to renew. In order to prepare the return, we have to have a 1095-A. We absolutely have to have that form in order to complete the return. There is no longer, and this has been here for a couple of years, we no longer have a shared responsibility payment for failure to have health insurance or a qualified exemption. So the main thing I want to focus on here is, did the individual have insurance through the marketplace? If that is correct, so H10 is going to guide us through that questionnaire. For each person on the return, did the person purchase medical insurance via the healthcare.gov or penny.gov? If yes, we're going to complete the form 8962 with the form 1095A. We need that information in order to prepare the return. Now, generally, that form 1095A should be received by January 31st. And we'll actually switch over to there as we kind of talk about this. The premium tax credit is going to be eligible for people that were enrolled at some time throughout the year for a health plan through the marketplace, as long as they had what they call minimal essential coverage. Those are the only plans that are going to be eligible. They may be entitled to a premium tax credit as long as their federal income is more than, or at least 100% of the poverty level. If they're under 100% of the poverty level, then they should be eligible for Medicaid. They also have to be under 400% of the federal poverty level to have a premium tax credit applied. And I'll talk about that in just a second here. The main reason why we have the individuals go through the marketplace is because the marketplace will actually allow them to apply an advance credit against their monthly premium. So the marketplace is going to project a tax credit based on information from the taxpayer, how many people are in their family, how much income do they anticipate here for 2024. So what's going to happen when they do that, or they've done that last year, the marketplace will say your monthly premium is $200, but we're going to give you a credit of $195, so your monthly cost is $5. Well, that works out great. You only have $5 per month to pay for healthcare. But at the end of the year, we have to get that Form 1095-A to effectively reconcile the amount of credits received versus a credit that was actually due to the taxpayer. So we have to file Form 1040 if we get the advanced premium credit, and we also have to have that Form 1095-A in order to prepare that information. Again, they should get that 1095-A by January 31st. They can always log into their Marketplace account or call the Marketplace Service Center for additional information if they didn't get it, or if it somehow doesn't look right and they need one reissued. So just want to mention here, if we do get the premium tax credit, we're just going to enter the information off the Form 1095-A. TaxSlayer has some very good input sections. If it's all the same for the entire year, very easy to do. We can also do it on a month-by-month basis. TaxSlayer is going to calculate the amount of credit for each taxpayer based on several criteria. The advanced portion will be readjusted. It may need to be repaid if the calculation differs from that estimate. This is unfortunately a situation we've run into on occasion. This is generally where the taxpayer has received more income than what they originally thought. In my situation before, I had a taxpayer who received a distribution from a retirement plan. They weren't anticipating it and ended up having them pay several $1,000s more because they're now above the 400% of federal poverty level. Again, we can take a look at some options. We can try and get their income beneath that 400% level. Some great ones we talked about tonight, or contributing to an IRA or HSA. Again, you can actually have your spouse do that as well, so to really help bring your income down to avoid massive repayments. Technically, the taxpayer could have reported these changes with the marketplace. Had they known they had gotten some additional income, they got a raise, a higher paying job, they could have updated their information with the marketplace. However, they generally fail to do so. There may be a couple areas where shared payments or newly married taxpayers may be outside the scope of VITA. But if you do run into complex premium tax credit areas, feel free to pause the return. Generally, it means that someone may owe some money, so we probably want to make sure between your site coordinator, between kind of the management of the program, we have the right results coming in for the taxpayer and can work with them as best we can. If they owe a lot of money, they're probably not overly anxious about paying it right away, but we do want to prepare the return based on the information we have. Okay, and then entering into the very final discussion of this evening is the first-time homebuyer credit and repayment. This is great. This is going to be the last time I have to use this slide. It is on H4 of your 4012. Back in 2018, there was a credit that had been established for first-time homebuyers. They were able to get a credit that was going to be repaid over a 15-year period. Repayment started in 2010, which means that 2024 is the last year of repayment. So generally, a lot of these people have been already repaying part of that credit back for 14 years. This will be the very last time they need to do that. They should have that amount from the prior year. They probably already know. They may have a letter, a reminder. You may see it on a prior year return. Oh, I'm sorry. Looked like I said 2018. I did mean 2008. Yep, sorry, going way back to the future here, back in 2008. Repayment would have started in 2010. Again, so that 15-year period ends in 2024. If they don't have the form, they don't have the letter, they can always look up at the irs.gov or call the 800 number on the screen. If for some reason that they no longer have the home, death of a taxpayer, they sold the property, or they no longer have a principal residence, they could try to go ahead and claim that they do not owe the credit back. However, fortunately, the very last year for the credit So this will not be discussed again after our session here. This will be the last time we have to deal with that. And hopefully the government realized that having a repayment of a 15-year period creates a whole lot of issues for tax preparation. So that is the very last piece I have for this evening. I know we covered a lot of information in a quick 2-hour session here, but I do very much love talking about credits and deductions because it does help go through that process. Let me just make sure that we are in good shape here. Trying to work with my multi-monitor environment. Okay. Looks like we are back and ready to go. Okay, so I wanted to bring everyone back here. Okay, so happy to stick around for some additional questions if anyone has any additional questions regarding either deductions, credits, or any other items that we talked about this evening or that have really come through as we've gone through the first couple weeks. I do want to remind you we will not have a session on Thanksgiving Day. We are going to give you the benefit of enjoying that time with others. So we will be back 2 weeks from tonight to finish up with state and local issues, as well as some opportunity here for talk about a couple other advanced topics, including military. Okay. Great question coming in on that first-time homebuyer credit. If the property was foreclosed, generally they do not need to repay that first-time homebuyer credit. We do have the form available. You can actually complete the form 5405 with the return and indicate why they're no longer responsible for repayment. So if the home was either sold at a loss or foreclosed upon, then they are no longer responsible. That also includes the death of a taxpayer.
Hey, Jared,
Yes, sir.
Kim, is it okay if, I'm not sure, I came in a little bit late, so I don't know if you told everybody or not. I got an email from Joe Solari that Lincoln Learn will be up and ready to rock with as of tomorrow. Tomorrow, Lincoln Learn is live. It should not have any more glitches. But kindly note, if you had a prior password, you're going to have to sign on. It's going to tell you to say you forgot your password, you'll create a new one. If it's your first time signing on to Lincoln Learn, you will go on to the Lincoln Learn website, say create a new account, and then you can go ahead and create your account name and then your password, and then you should have access. It also has, I think, a new area, but if you haven't received the email, Kim, did you receive the email from Joe?
Yeah, I did, and I mentioned it at the beginning. Yeah.
Oh, I'm sorry. Again,
No,
I'm
that's
sorry.
okay.
I just
Nope.
wanted to get that information.
No,
I should have known
thanks. No, that's okay.
everything. Yeah, ahead of the times, on top of the times and ahead of the news. Thanks, but I just wanted to share that because I just got that email from Joe today.
No,
Everybody,
I'm sorry. Go ahead, Al. Sorry about that.
I just wanted to wish everybody a happy, filling, and safe Thanksgiving. Please, everybody, enjoy it. Be safe.
Appreciate it. You as well, sir. We did have a couple questions that just came in, Kim, through chat. A couple questions. Rob had asked, do state returns typically open up in TaxSlayer Pro? So looking at the training portion, believe that the state return should be in there, but they may not be available immediately to work on. Do you know if there's timing on that?
Yeah, 2024 is not available in TaxSlayer, but you can go to 2023 and fool around with it in that tax year. I don't know how much difference there will be, but yeah, I mean TaxSlayer is pretty much down for now as far as 2024. You can still do returns, but they just have to be mailed in. You can't, e-filing's done for now.
And that's for the 2023 returns, you said, Kim, or is that for the 2024 for TaxSlayer if we have?
No,
actually,
2024 is not available yet.
Correct, yes.
Right, but for 23, if you want to go in to the practice lab and fool around, the state returns are in there.
Yep, perfect. Okay, great. Just want to have that clarification there.
Yeah.
Okay. And also a question that came in from Ernie about do we have any specific training on entry during TaxSlayer? So we don't have any formal evening sessions, but I believe, Kim, there are some trainings set up with the United Way of Lancaster here for more hands-on training for TaxSlayer, I believe.
Correct.
in January of next year, or at least in
So
2025?
December, we will be doing a training December 12th from 6 to 8 at the Lancaster office on King Street. And then on the 13th from 10 until 12. Those two trainings are basically for federal only so that folks will, and this is mostly for new preparers, but they'll know how to get into TaxSlayer and be able to do the return, because there are 3 questions on the certification test where you will need to use TaxSlayer to do a return. Now, in January, we will be doing what we're calling kind of our Pennsylvania, Lancaster County, and the PA 1000. We will be doing trainings the first week of January, the 6th through the 10th. We have 4 morning sessions and 1 evening session. The morning sessions are the Monday, Wednesday, Thursday, Friday from 10 until 12. The evening session is Tuesday from 6 to 8. Then the following week, January 13th through the 17th, we'll be doing like a TaxSlayer A to Z, where we will go through the entire process, give people lots of examples that they can work on. Same schedule there, Monday, Wednesday, Thursday, Friday, 10 until 12, and Tuesday, 6 until 8. And those will
Kim, Ernie here. Question, please, about what you just said. Is any of that available via Zoom for those of us from the Poconos?
no, it's not.
Okay.
Unfortunately, those are face to face. Maybe Hal can put something together for you guys.
Yeah, maybe we might just get a convoy and go down there. We'll
Well,
figure
let me
something out.
know.
We'll figure something out. All right. Hey, Kim, if you could shoot me those dates in the email, because you went so fast and I'm not
Yep.
the best.
Yeah. Now the trainings, yeah, I'll email with you how, because the one training is full. The other one is available. I do have seats available. So, but I just need to make to know who's coming and when, so we have plenty of laptops and stuff set up.
Okay. Okay. All right. We'll work something out. I may come down, take the training, and if I get it good enough, I can give it on this side. Hey, Ed, give me a call, okay? Ed Dietz, give me a call when this is over.
Yes, I will. I saw your note. I've got your number. I've got the phone in my hand.
All right, cool. Bye.
Okay.
All right.
Great.
And just on one other one, I'll handle this one here in the chat. So possible a taxpayer can take an IRA deduction and a retirement savers credit. Absolutely. This is kind of a great way that we can double dip by taking advantage of that IRA deduction and also the retirement savings credit. So that can actually enhance, basically help augment the taxpayer going ahead and contributing to their own retirement account. So great to be able to set that money aside. I did mention a little bit earlier in the session about that emergency fund. The government's also being a little bit more realistic that people may at their 20s not want to put money aside they can't touch for 30 years. So we're going to see more information coming about that emergency fund. In fact, we may have a new program available on emergency funds available moving forward. But absolutely, Barry, great strategy to go ahead and do a deductible IRA and also get their retirement savers credit on top of it, effectively helping to pay back some of the money that they had already just put into the IRA. Some great techniques there.
All right. Well,
and I know those of you in the Poconos are probably watching the snow and precipitation falling. So certainly we'll let you go if need be. I will be out running around for a little bit if anyone has any additional questions. But everyone have a great holiday season. Hopefully you have a great Thanksgiving, and we'll see you back hopefully 2 weeks from tonight. Talk about a couple more issues. So best of luck to everyone. Enjoy the holidays.
thanks everyone. Bye-bye.